Hello and good evening, everyone. I'm Crispian Dice, and I welcome you all, lovely ladies and gentlemen, of course, to this Women's Week celebration. As we get started with this webinar on financial freedom for women, where we'll be discussing the importance of having the right mindset, the myths that exist with investments among women, and finally, the mistakes made in the past, which should not continue in the future. If the audience has any questions, you can write in the chat box, direct message to Everguard Investments, and we'll answer them in the end of the webinar during the Q&A session. Now to begin with, we have our interviewer, Anika Ahuja. She's an ex-banker, headed a branch in ICICI at a market like Mumbai, and has 15 years of experience in finance industry. Thereafter, she was a faculty trainer at Times Center, training for banking jobs, and now an entrepreneur, has a firm by the name of Orion Promotions, which specializes in corporate promotions and gifting. Answering her questions is Arjun Sarkar, CEO and Head of Investments at Everguard. He comes with more than 2 decades of industry experience, out of which a decade of investment management experience. He has a track record of breaking and beating markets consistently based on his asset allocation domain expertise. And the journey, which began specifically at University of Toronto MBA 16 years ago, which at that time was top 7 in the world. He's also an investment coach to CXOs, to prominent companies like L&T, Axis Bank, Nokia, to name a few. Business owners, high net worth professionals across the globe, and regularly speaks at leading investment forums and organizations. His organization specializes in financial independence solution, and has helped women across all walks of life. And he practices what he preaches. He has applied his learnings and principles to help his client to get a sense of control over their money that eventually leads to a peace of mind. With that, I would like to hand it over to Anika.
Thank you, Crispian.
Thanks for the warm welcome, Crispian. Good evening, Arjun.
Good evening.
Good evening. So, Arjun, I really look forward for an interesting conversation with you today. As per our theme today, like it's financial freedom for women. Arjun, my first question to you is like, why do you come up with this theme and why now?
Correct. Great question, right? So, Anika, I'm sure that you must be seeing these financial freedom webinars or events being promoted across social media events, more so in the last couple of years, right? But my journey started 15 years back. And so let me take you to 2006, where I graduated from University of Toronto in MBA, with an MBA in strategy and finance. I was always good with numbers. And now that I had an MBA in finance under the belt as well, I became the investor bug had to bite me at some point, right? So the only problem was I was overconfident at that stage, right, of my abilities. And we all know what happened in 2008. You would know because you're a banker. Yeah,
it was a nightmare. Yes.
It was a nightmare. It was for me as well, because I lost 50% of my money. I was making decent sum at that point of time. I was working for a Fortune 500 company, so they paid well, and I was investing. So I had started implementing what I'd learned, but the overconfidence and the fact that I thought I knew a lot cost me dearly, right? So initially I was upset like everybody else, but I soon realized that I was 32 at that point of time. So I had a long career in front of me. I knew that I could make up the money, but I started thinking about the folks who had just retired or who were planning to retire in that time frame. And I said it would have been, like you mentioned, right, a nightmare for them. Right. So I, being an engineer, I said, okay, let me plan my retirement. So I went to the ever trusted Google and pulled up a retirement calculator from one of the top financial service institutions. And you know the typical questions they ask, right? So I started inputting my answers, right? When do you want to retire? Okay, I want to retire at 58 or 60. How much do you plan to invest? So I my input was in dollars at that point of time. But then it started getting tricky, right? So they asked, what return on investment are you expecting from your investments? Now here was a guy who had just lost 50% of his investment, right? So I was thinking to myself, okay, should I go by rule of thumb? Should I put 10%? So if I do that, and the retirement is 25 years away, what are the chances that I'll hit that number, whatever number they were about to display after I inputted my thing? It was not meaningful. I didn't think it was logical, right? And then the next question came, and the next question was, what is your risk profile, right? So how would you rate yourself in terms of taking risk? And I said, okay, my risk taking ability was probably 8 on 10, really high in 2006, 2007. Now, if you ask me, it's probably at a 2. So I am very conservative. So that also starts fluctuating over the next one. And I have no idea how that would fluctuate over those next 25 years. 25. So what I realized immediately was that a cookie cutter approach to this won't work, right? So I started asking myself, it's more than the numbers. You have to ask some fundamental questions. And those fundamental questions was, what do you mean that when you say you will retire in 25 years, right? So if you really think about it, it's basically you will hang your boots, you'll stop working for a salary, and you'll be sitting at your home or on a vacation. You amassed a lot of corpus, and you are confident that corpus will maintain your standard of living for the next 25 to 30 years. And with the medical advancement, that will only increase. It's not retirement. It's basically what you're saying to yourself is you want to be financially free, right? Free of the burdens. You're financially free. You don't have to think about money anymore when you retire. So that's how the concept first came to me around 2008, after losing half my net worth, right? And that too quickly. I come to your second part of the question. Why has this game? Why now, right? So I'm doing this webinar now because in the last 2 years, you know that everybody's gone through hell, right? So
COVID has changed.
Yes, businesswomen, businessmen, entrepreneurs, salaried professionals, freelancers, doctors, dentists, male, female, everybody has gone through a bad time, especially through the money. Whoever has a big corpus, right? And especially people who are about to retire. And with the fixed deposit rates also falling to levels which nobody had seen, right? So even if you were depending on safe assets, they were no longer safer. So I thought now is the time to reach out to folks and get a little more deeper into the subject rather than it being at a superficial level. I'm not so sure if a lot of folks out there know what to do, especially women, which I would delve into a little later.
Well said, Arjun. As you emphasized on the financial freedom mindset, so I would like to go ahead, like, what is this exactly financial freedom mindset?
All right. So the financial freedom mindset is basically, you should have the freedom to, with the emphasis on the word to, do whatever you want, whenever you want, wherever you want. So if you read that sentence carefully, you would realize that financial freedom is more about time rather than money, right? You need the money to reach there where you've amassed a corpus which will sustain you consistently for the next 30 to 35 years. But actually the mindset says that freedom is, you have time to do whatever. So imagine this, right? So if you tell me you are working for a company, even if you're at a high level, senior level, or even if you're at a mid-tier level, do you have the freedom to go on a vacation starting tomorrow, even if it's for 7 days? Would you have, that's a question to you, Anika.
Definitely. Means I really have to plan well. The time constraint would be, can't be just taken like that. It has to be considered well before any sort of a vacation and all. But who will not like to go for?
Right. So, and now let's compound the problem, right? What if I tell you, you have to tell your boss, I want to go for a vacation, not for 7 days, for a month. And I want to do that tomorrow, starting tomorrow. Is it possible?
Not exactly.
Okay. What if you're an entrepreneur? You have a company
Yeah.
where you are totally so immersed there also, because you are the boss and you are immersed. If you're doing majority of the job, you cannot do it, right?
Right.
So,
right.
so
The
that's
plan
the
needs to be there.
So that's the mindset, right? When I say financial freedom, you have the freedom of time to do whatever you want. Till that time, you're not financially free. You can't call yourself financially free. Okay.
Right.
Next point is of the mindset is freedom from, with the emphasis on the word from, right? Freedom from fear of losing a job if you're working. Freedom from depending on any firm, your boss, your family or friend to meet your wants and needs, which can be bought with money. And it could be vacations, it could be real estate, it could be anything, whatever you want.
Anything which you want.
But
yeah.
so you have to have the freedom from. So basically what I'm saying, you don't have to be dependent on anybody except yourself.
Right.
That's the mindset. It's not about money. Money just is the means to get you there.
Yes.
But you have to be absolutely clear about what it means. All right.
Right. Definitely. So now having the clear mindset that money is not everything, that obviously the time factor is the main thing where we need to, money will be the means to go with that. That's really important.
Right. So I'll just play a video from one of our clients, Richa, and let's hear her talk us through her journey.
While I was growing up, I saw that in most of the families, it was the men of the family who were the primary bread earners and also the decision makers on the financial matters. There were few families at that point of time as well where women were also earning, but they were secondary source of income. Despite being an earner, they still had very little say in the financial matters like savings, expenses, big purchases like property, etc. So when I saw this in my childhood, it was very clear to me that this is not the life that I want to live. I don't want to be treated as secondary all my life. I want a life where I'm in charge, play an equal part as the men of the family in any matter, including the financial matters. Today, if I see around, I see a lot of women are working or are entrepreneurs, and hence making a living on their own. But I'm still not sure if they are even today taking decisions on their financial matters. So the question is, well, yes, I'm earning, but how that money should be spent, where should I be spending it? I don't have any say in it. Is that fair? And I thought this has to change for me. Right? So me and my husband generally partner in taking any big decisions which impacts the whole family. And there are certain, in many cases, I take the decision independently. So I can share one example. I decided to retire early, and I have a lifestyle to manage, right? And my PF is not enough to take care of it. I'm quite confident that I will live at least till the age of 80, or maybe even till the age of 90, who knows? And I want to maintain the same lifestyle as I have today, even after my retirement. Can I expect my daughter to take care of me? Well, not quite. Even if she is willing to do it, I would not want her to see me like a burden or maybe as a problem. Hence, I took the decision to plan for my retirement. I wanted to retire in next 7 years, and right now I'm in the process of building a corpus which can enable me to retire in next 7 years. I'm saving money and I'm investing it. Of course, any decision that you take cannot always be your skills. There are times when you need to consult people, right? Taking help or taking, advice is very important, because you cannot know everything on your own, and that does not mean that your independence have been taken by someone else. So I took help from a consultant, I took help from people who are experts in retirement solutions, and I'm on that journey for last 3 years. And when I think about it, if I took the right decision, I feel that immense pleasure that I did the right thing. Today, I feel very satisfied, peace, and calm, and absolutely confident that after 10 years, I would be enjoying my life even more, where I can do things that I want, and I will be retired, still not compromising on my lifestyle. So, this is what it means to be financially independent to me. Thank you.
Anika, I think there were a couple of key things that Richa mentioned, right? She wants to be at the same standing as the men. She doesn't want to be dependent on her children. And the most important part, which was the ending, right, where she said, "I have a sense of calm and peace, which I'm getting because I'm on this path to financial freedom," right?
Basically. That's peace. Peace of mind is the most important piece. After doing everything, you are achieving your goals, and then at last you are at peace. That yes, what I was aiming at, I am achieving it.
Correct.
Fine. So that was really nice, Richa, that she could lighten her experience with us. So now my next question to you, Arjun, is like, what are the common myths like that are hurting the women most as of now?
Okay, I'll point out to the 3 common myths that I've heard from my repeated conversations with ladies across the spectrum, be it with my family, friends, and also our clients, right, who come from different walks of life. And let me start with the first one, right? And this is the big one. Finance is the domain of men. Okay, and you would have heard that a picture speaks or is more worth more than 1,000 words, right?
Yes.
And I think if you look, you are a banker, you would recognize all of them, these ladies, right? They're the CEOs and chairmen of all the top banks that you can think of, right? So it's like we have the top insurance company, CEO of top insurance company, SBI, JP Morgan South Asia, Axis Bank, HSBC, Kotak, and an ex deputy governor of RBI. And on the right is Madhavi Puri Buch, who has taken over the regulator as the chairman of the regulator Securities Exchange Board of India, and which is one of the strongest regulators in the world. A lot of people don't know this, but SEBI is ranked in the top 3 in the world in terms of regulations for finance.
No, even I had a long back, I had a chance to meet her. It was just for a few minutes only when I was in Delhi at ICICI.
Okay.
I was earlier into rural and agri segment of ICICI corporate banking division. So she was there for the first branch inauguration in Delhi. So it was really an amazing experience with her at that time.
Right. So I've tried to dispel the myth with the picture. I don't have to say anything more on this one, right? Okay. Next. This is a big one. I'm independent because I earn a salary, right? And some say that I earn a good salary, which may be the truth. It's not. I'll give you an example of a homemaker who is actually independent in my eyes and financially free as well today, right? So she's a family friend, and she's a mother of 2. She has been managing the finances first for her husband, for the household when the kids were small, throughout. And now she's managing the personal finances of her kids who are entrepreneurs and successful entrepreneurs at that. And what really inspired me about her was when I found out that she has this book or a notebook where she takes notes of all the mistakes that she has made in the past, and which is a habit of one of my mentors, Ray Dalio, who is the biggest hedge fund manager in the world. They manage around $165 billion of assets. And he also talks about this, right? He always used to write down his mistakes and learn from them. So you will make mistakes. Even the experts make mistakes, right? But if you are on the journey of investment, you can learn. So I'm really inspired by this lady. Anika, what about you? Do you agree with this myth?
Definitely, like it is something, until unless we'll take it on ourselves, we'll not be able to practically do it. And who doesn't make mistakes? There's no one who is perfect. Like mistakes makes us achieve a next level of perfectness. So yeah, what I'll say nowadays, I have observed it that being independent, being earning is really a very common phenomena, that I am earning, so I am independent. The philosophy comes is that I'm doing expenditure because I'm earning, but then that earning is not developing into a wealth creation. It's like I can take care of my expenses because I'm earning.
Correct, absolutely. So it is more about expense management, which has a couple of zeros, 2 or 3 zeros,
yes,
but it has to move to 5 and 7 zeros, so which would be in lakhs and crore, which is asset building, right?
Yes.
And like the first myth I've dispelled, women have that ability to do it. It's just that they have to step out and break this myth and start, at least initiate that journey towards financial freedom. All right. Coming to the third myth, and this is a big one, right? If you've taken nothing out of this webinar, if you take this slide and put it into practice, I think half the battle is won. Saving money is same as investing money, right? That's absolutely wrong, right? So if you can see the picture, so in the last 40 years, the inflation in India has been 6%, which seems to be a low number, but what it actually means, eroded the purchasing power by 95%. And I have a definition of investing money. So if you say that you are putting money in FDs and you are investing in FDs and post offices, you're not investing, because the definition is very clear. It has to beat inflation by a couple of percentage points over the long term. So inflation is a silent killer.
So inflation is something which is really very not common for who is a non-finance into a non-finance sector. So this is something which your experts can enlighten the fact of inflation in terms of calculating the returns and all, which generally is not taken care, especially for a non-finance background.
Yeah. So let me make it even more easier, right? So vada pav khate the. 10 years back, it used to cost around 5 rupees. Today, it costs around 25 to 30 rupees. It's the same vada pav, right? The ingredients haven't changed. It's very simple. We are not, the restaurants are not offering it on a silver plate. So why is a 5 rupee vada pav cost 25 rupees today? Right? So that's inflation for you.
That is inflation. Yes.
Okay.
The value of money.
Yeah.
Like overcoming these myths, Arjun, like my next question is, what are top mistakes which women should avoid, to achieve their financial freedom target?
Again, 3 top mistakes that I could think of, I would take the audience through. The first mistake is putting investable money, that is extra money that you have after your expenses, in so-called safe assets, right? So yes, FDs in absolute terms, suppose is giving 7% to you, 100 rupees will go to 200 rupees in 10 years, right? Or 1 lakh will go into 2 lakhs after 10 years. Let's debate this fact that it is a safe asset. I don't know how many people realize this. People think it's a safe asset, but it's actually not, because of inflation. But I'll go a little deeper into it. So suppose you have 50 lakhs in an FD in a big bank, and that bank goes bankrupt tomorrow. Well, Lehman Brothers was there for 150 years. It did go bankrupt. So the evidence is there in history, right? So I don't want to scare people off. Indian banks are in good hands, but you can never say never, right? So let me take a recent example. Yes Bank was a good, decent bank up till 2018.
Yeah.
A lot of people had had FDs and saving accounts in Yes Bank. In 2020, RBI put a moratorium that you can't take out more than 50,000 rupees. Now, you may have 50 lakhs in the bank sitting there, but if you need money for an emergency and you don't have access to that money, what use is of that money? So is it a safe investment? I'll beg to differ, right?
Obviously not. Yeah.
Same with tax saving insurance policies, ULIP. I see a lot of women invest in tax saving instrument. Bacha lete hain thoda paisa. No harm in that. But all your investable surplus going into tax savings, that's a problem. That's a mistake. And ULIPs is basically unit linked insurance plan, which is basically your insurance company putting money into the markets, and the fund managers are not at the level of mutual fund guys and PMS. And there also you don't get more than 6% from a good fund over the long term. So if the inflation is 6% and your return is 6%, basically you're earning nothing over a period of time, right? And the third is cash and gold. Again, cash for expenses is okay. But anything above that, it's like cash under the mattress, right? You're earning nothing. In fact, it's the worst investment, if you ask me. I can't call it investment by my definition, but it's the worst thing that you can do. And gold, you know the love of gold in our country, right?
Yeah.
So you already have a lot of gold in terms of jewelry in any household. So you can invest, but I won't use the word investment. It's an insurance, right? So for in volatile times, you can put money in gold, like gold funds and gold ETFs, which have no problems like storage, no problem of purity, right? So you can put your money. I'm using the word put, not invest your money there, right? Having said that, I want to be clear. I'm not saying that don't put any money in any of these asset classes. If you have a foreign vacation where you know that you'll need 5 lakhs in 1 year, please put your money in FDs. I would also tell my clients to put their money in FDs with good banks, the top 3 banks, private banks of the country. That's what I would do. I would have cash. I would have gold. But if you have gold jewelry, please wear it. Session, if I give my wife a diamond ring, I would want her to wear it every day, right? Not put it in a locker from an investment perspective, right?
Right. In my banking experience, I could relate it like majorly our female clients who used to walk into the branch. The only philosophy at that time was like, let's invest in, put it in FDs or recurring deposits. But yes, obviously seeing that inflation factor, the time factor, the returns factor, whenever that money is being needed, after seeing whatever returns they are getting after taxations and all, it's hardly anything. I think so. We are at the square one position with that same amount. This point is really an eye opener. So I think we will not.
Okay, good to hear that. Okay, let's go to the next. Chasing bright, shiny objects. And you will be surprised, Anika, and my audience also, I want to say, I have got requests more from our lady clients. For what do you, how, in terms of questions, can I invest in cryptocurrency? Where should I invest? Right? So my view on cryptocurrency is that it is a gamble. It's as good as going to the casino. I can speak on it for an hour, but because of paucity of time, I'll spare the audience with my views on the subject. But needless to say, it is a gamble. Now, the second point, FANG ETFs, right? So it's an acronym. F is for Facebook, A is for Amazon, N is for Netflix, and G is for Google, which is now called Alphabet. And ETF is exchange traded funds. I won't go into the technicalities of the thing, but of late, because they have done really well, in fact, till October, November, they had done very well, right? They were the fastest growing stocks, and the portfolios which had them grew really high, and it caught the imagination of all the young investors, the new investors, and people wanted to invest in them. And I had told a couple of my clients that please don't do it. It's at the top of the cycle. The landing will be hard. So the FANG ETF, one of the Indian AMCs owns, has a FANG ETF that has fallen by 22% in the last 3 months, right? So any other fad of the day, the recent stars, what becomes a fad in the investment world? Whatever has given very high returns in a very short term, that becomes the flavor of the day. And that is the most riskiest thing where you can put your money in. Because what the wise people do at the beginning, the fools do at the end. And it's not my quote. It is a quote from Howard Marks, one of the other greats, investor greats in US, right? That's his quote, basically. But people get so carried away by the herd mentality that because the good news, if your friend has invested into one of them, they will tell you when they made returns. They will disappear when they've lost.
They lost, yes.
They'll not come back to tell you that story.
I was just saying that is actually the world goes with the word of mouth. So when we listen good, everyone follows. We just following the race, whatever is happening good.
Right. So let's come to the third mistake. And again, in mistake, this is the biggest one. Okay. So I want to spend some time here because there is some maths involved. Right. And I know how many people love maths. Right. So not giving enough time to your investment. So we all have heard of this word called compounding at some point of time. In fact, if you remember we studied this formula in our grade 9th, as far as I can remember. So A is the amount, final amount that you make. P is the principal amount that you invest. R is the rate of return, and T, the exponential component, is the time that you stay invested for. Right? Now, what do investors focus on? 99.99. And here it's not about women, even male investors, right? Where do they put their maximum emphasis on?
Rate of returns.
Which is right also. Right. So it is directly proportional. The amount is directly proportional to the rate of return, right? So you can't have a negative return. Yeah. You cannot have fixed deposit return, which I just talked about, right? So you can't have a low return. You have to, but you have to have a decent return. Yeah. But that's not in your control, right? There are hundreds of variables in play. Could anybody of us have forecasted the Russian-Ukraine war in February? No. Invasion? No. But if you had followed Vladimir Putin's statements, and if you were following him, you would have known that he was about to do it. It was just a matter of time, right? But what about the macroeconomics like oil prices? What about politics, right? There are hundreds of variables that determine the outcome or the rate of return from an asset class, right? Who will determine that? If anybody tells you today that I'll give you a 10% return, 12% return, is lying. They can give a range. Yeah. They can make an expected range that, okay, I'll probably give you more than the markets. The market is expected to give you 8, 10%. We'll give you 11, 12%. That is fine. But if anybody gives you a number, you have to start running in the opposite direction and fast. Okay. Now, what do the investors ignore? Time. The element which gives you that 4x, 5x, 10x returns is time, because it's an exponential company, right? Who controls time? Time is the time for which you hold your investment. That is in your control.
That's okay, fine. For the whatever time I want to invest, that time is in my control.
Yes, but we ignore that. We ignore what we can control, and we put all the emphasis on a directly proportional variable, which will give you linear returns versus exponential returns. And that is not in our control also. So I would highly encourage all the participants to encourage your colleagues, younger colleagues, your cousins, sisters, daughters who are young to start investing early, because T is what will make them wealthy, and they'll be more wealthier than you, even if you are the CEO of an organization. If they start at the age of 20, I started at the age of 32. If they start at the age of 18, even with a lesser amount, they will end up wealthier than you. I can guarantee it. All right. And the next thing is timing the market. This is another one, a big one, right? Abhi market gir gaya hai. Now, is it the right time to buy? Now the markets have gone up. Is it the right time to book the profits? So let me give you a research stat from across the globe, right? And if you did research of out of the 250 days when the market was open or trading, out of the 365 days, and suppose you had invested 100 rupees and at the end of the year you made 110. If I were to ask you, calculate, just pick up the days out of those 250 days which contributed to 80% of those returns. So in the market, do you want to hazard a guess how many days contributed to that 8% out of the 10%?
I'll be really not able to get into that figuring out those days. So
okay, so I'll make your job easy, right? So it is around between 10 to 12 days in the entire year. Now tell me one thing. Who can predict those 12 days in the year? Does it happen over the next 12 days? Does it happen in this month? Are they bunched across? Would I get 3 out of the top big days return making days in February? Or would it be 5 days spread across the 5 months? Nobody can predict that, right? So isn't that a wasteful exercise? Even Nobel laureates haven't been able to do it. So I'll give you an example from 1997, I believe. There was a company called Long-Term Capital Management in US. Made out 4 Nobel laureates started it. 4 or 3 Nobel laureates started it. And they were doing very well. They were giving outstanding returns for the next 3 years. So they became even more confident about their abilities, right? And by 2000 market crash, they were wiped out, bankrupt. So if the Nobel laureates cannot do it, how can we do it? So predicting, trying to time the market is one of the biggest mistakes, because the moment you do it, you are actually taking out money for some time, right? Yes. And if you take out money at the wrong time, what if that was the day when the market gave 4-5% return? Yes. You would have lost that entire opportunity, right? So don't try to time the market. It's not possible. Only God can do it, and we are not God. Start early, and if you've not started yet, start now. Not too late. It's never late, because even if you've retired and you have 20 or 30 years of life in front of you, you have to invest. Otherwise, you can't beat inflation.
So, Arjun, like by taking care of these mistakes and doing the appropriate planning, time management. So, what are those important takeaways which you like to highlight our audience with?
3 key takeaways. I've already gone over them. I'll go again. First is change your mindset to the financial freedom mindset, which basically needs a financial freedom corpus. You need a corpus by the end of the next 5, 10, 15 years when you're planning to be financially free, to give you that money which will last for the next 25 to 30 years. So it's very important. So for that, to achieve that freedom corpus, you have to invest. And I've given the definition of investment, right? So you have to have a plan and date for achieving your financial freedom corpus. If you do not have expertise, please go to an expert. That's one. Second, invest your money versus putting in savings products. You have to save. You can only invest what you can save, right? So you save more, invest more, but do not put in savings products over and above your emergency fund, like I said, or a target that is just 1 year from now. Suppose you want to travel abroad and it's in the next 6 months. Save that money in fixed deposit or in mutual fund, which is easily accessible. You can reach, you'll get that money within a day, and you will not lose your principal, right? And the third is focus on time you can stay invested versus timing the market. I spent some time on the last slide. That is very, very important. So my key message is start investing now. And we can take questions.
Thank you, Arjun, for your insights on the 3M mindsets, myths, and mistakes. I'm sure everyone has taken the message from this webinar and has given them something to think about their finances and help them to take the first step towards financial freedom. Thank you, Anika, as well for joining us for this webinar, adding value to with your presence and insights through your questions. We'll take some questions, Arjun, which we got during the webinar. The first one is, how much should one start with, and how do I know how much will be enough for my financial freedom?
Okay, two parts to the question. I'll answer the first. How much you start with whatever is investable, right? So start simple. If your financial assets is say 1 crore and your liabilities like loan outstanding on homes that you purchase is 50 lakhs, it basically means that you have 50. I'm trying to simplify it a bit. It is a little more detail in that sense, but let's keep it simple, right? So if you have 1 crore in assets and 50 lakhs in liabilities, you have extra 50 lakhs investable surplus. I would invest the whole amount, but everybody cannot be that rational. So you have to be at least reasonable. So at least say 50%, right, of your investable monthly surplus, invest every month. And the lump sum of 50 lakhs, if you have investable surplus, at least invest 25 lakhs in assets, which give you more returns than inflation. I hope I've answered that question.
Right. Thank you, Arjun. The second question, which is a bit women-centric, which has come from our audience, is, how do I convince my family about my financial freedom and investments, and what do I tell them?
Okay, you start slow, right? Because it's ingrained in the psyche. I know that in the 95% of the cases, the male of the house tries to buy. It could be a father, it could be a husband, later on it could be a son, if you've lost your spouse, right? So the first thing to do is take it slow, right? So do this analysis and take it to them and show that I've done this analysis, right? See, we are putting money, we are leaving money on the table. Where are the assets distributed across? Put money into FDs, we have money in stock, we have money in mutual funds. Can we discuss and share? If you do that grunge work, at least you understand that where the money is lying around, right? So that is one way to. So start slow because it's ingrained. Add value first. With everything, you have to add value first. Show that you are that you can do it, right? And you've done something which they may not have done or had the time to do it. So start with the easy steps first. Don't take the giant leap just because you were on a webinar. You start with the easy step. Consolidate your information. That's where I would start with. And the second part was, how do you find out your financial freedom number? Was that the question, Crispin?
Yes, that was the question. How do I know how much is enough for me?
Okay, that's a technical question. In our case, we take the information from the clients, we crunch the numbers. There are a lot of variables to take into consideration, and then we arrive at a number. It can't be done on a Google calculator. Okay, Crispin, I can take a couple of questions. How do regular salaried people find a financial expert, and how do we know they know the subject? What questions do I ask them to figure out their expertise? Great question, right? So most of the times we think that we are the financial experts, or my father is the financial expert. I will start by answering the question with a analogy, right? So if I have a knee surgery, right, and my father is an army officer, even though I know he loves me and they have the best intention in mind, I won't go from my knee surgery to my father. I'm sorry, right? Similar with investments. It is like a surgery. So I'll give you some questions that you can ask your financial advisors if you have one, or if people approach you, right? I'll start off by saying who are not experts, right? So anybody who's an agent is one who works for a particular institution, only one institution. For example, LIC agent only works for LIC Corporation, or bank relationship managers. Sorry, Anika, you're from that industry, but I have to say this, that bank relationship managers, because they have their loyalty towards the bank, their boss, right? And that's why they're paid commissions on it. They are not experts, even if they are from the top banks, right? Now, the questions I would ask my advisor, that first of all, do you offer products or do you offer solutions? Because I'm talking about retirement, financial independence, right? it would require investment. It's over a 20-year period, right? So do you give solutions or do you give products? Because if you are giving products, that's a red flag. If I start pitching a product, or take this fund, fund A, fund B, or this insurance product, that's a red flag, right? What we need is solutions, not products. That's number one. Number two is that obviously you would have clients for this, whatever you are pitching to us, you would have a client base for it, right? What percentage of your client base has applied for this or is utilizing this solution? Number one, what has their experience been with that solution? Are they happy? And the answer to that depends on, have they referred folks to you? And the fact that they've stayed with you, and for how many years have they stayed with you? Have they left you? The folks who had come 5 years before, have they left you during COVID? If that is the case, if they can't answer that question, it's a red flag. Or even if they hesitate to answer that question. And the final question that you can ask, only 3 questions you have to ask, not difficult, right? You have come, Anika, suppose you come to me and say that I'm coming from ICICI Bank, I've answered the first 2 questions very well. I'll ask you, so you are pitching to me a financial independence solution, right? How much have you invested in this solution? Have you taken those products from the bank, your bank, right?
Right.
And I can answer that question for you. 90% will answer no.
Yeah, obviously. Not everything can be taken.
That's your giveaway. So if I am telling that I am an expert in financial independence and I am not financially independent, or I'm not on my path to become financially independent, and I have not invested my money based on what I advise my clients to do, or not advise, even suggest my clients to do, then there's a problem, right? Then you cannot be an expert, basically. So those are the 3 questions that I would ask. And I think I can take the last question. How do I know I have enough surplus to invest? Can you give us some tips on budgeting? So I think I've answered this question with that cash flow statement. Just do that exercise. So our mothers used to maintain a diary, right? They still do, right? One important thing which we have implemented in our family for the last 15 years, ever since I've been married, is we've also had a spending budget. So everybody has a saving budget, but nobody has a spending budget. Spending budget means you have to spend this money on yourself. So you have to enjoy now. Financial freedom is 20 years from now, right? But I'm living in the present. For an imaginary future, I'm doing it. Yeah. But I want to spend on myself, on my clothes. And that also you can understand. Okay, 5% of my entire inflow or the surplus, I have a spending budget on that. You like clothes, you buy clothes. A boring guy like me buys books. But I have a spending budget, right? So with that, that's a wrap.
If anyone in the audience wants to ask some more questions, you can send us an email on our email ID, investments@everguardlife.com. With this, I would like to thank everyone for joining. Thank you, Arjun, and thank you, Anika, for your valuable time. And have a good evening.
Thank you, Anika. Thank you, Crispin, and the whole team that helped put this through. And thank you, the lovely audience. Thanks, everyone. Have a good week.
Thank you.